Hello, everybody, and welcome back to the M3 Market Update. I am here in Miami. It's very windy today, so you might hear some uh, patio furniture moving around. Um, Not as bad as it is in California right now, but still a little windy here. It sounds like we also have some storms brewing as well in the tropics, so stay tuned. Okay, so welcome back, everybody. Thanks for joining. It's been a little bit crazy as I'm trying to get settled here, helping a client in Miami. Kind of starting to feel like myself again. It takes a minute when you do this much traveling. So thanks for bearing with me and welcome back. So, as always, and I guess this is just going to be my tagline, there's a lot going on. And so last week there was a bit of a stir, in terms of the builders. Sentiment came in down, which was a little shocking to everyone, but not really, or it shouldn't be. But I still think people just don't understand the mechanics. It's almost as if everybody has just forgotten how to truly look at these companies. And I hear it from just about everybody telling me, the balance sheets are going to be fine. Guys, all I can say to you is that I have been on these sites. I have seen these homes. I have seen the prices that they think they're going to get, and they're not going to be fine. So, this isn't investment advice, but I just want to say to you that if you think, just contact me. I'll give you an address. There's probably one very close to you, and we'll talk a little bit more in this in a few minutes about kind of what I saw on my site visits here in Miami. But in terms of the narratives out there, I just want you to keep in mind that they're very strong, and that in many ways they're out there for. Think about it as marketing, and I hate to say that, but really our financial media at the moment, besides those writing and independently on Substack and things like that, it's just an ad campaign. And so just keep that in mind as you hear these narratives. And of course, we also heard Buffett decided to actually invest in a few, including Lennar. I have some different ideas about that. Now, kind of the stock market, that is not my area of expertise. You should be listening to someone else on that. But I could see two different things. I could see that this is a long-term play for him. We will pivot to affordable housing before the election in 2024, meaning it's going to be on the lips of every single politician. And whoever gets it right is probably going to be one of the winning candidates. And so, there's already a ton of government programs out there. Just Google down payment assistance in your state. You'll find that there's a huge HUD budget proposal out there for about $10 billion. This is going to get really interesting as we kind of go into this debt fight, which I think is brewing. So, but I honestly believe that no matter what, HUD will probably get its money, just because no politician is going to want to be blamed for the shortage of affordable housing. And I think, guys, as people start to realize and see what I see, all these vacant homes everywhere, all over the country, vacant properties, and it is systemic. And yet, at the same time, your homeless populations are increasing because we have a ton of vacant properties that people use for leisure for their second homes. Pretty soon, though, they're not going to be able to afford those. As well, we have all this long-term rental inventory that was snapped up, all this short-term rental inventory that was snapped up, and a lot of it, and we'll talk more about this a little bit later in the show, was built specifically for short-term rental and long-term rental. So there's a ton of inventory out there. It's not marked. So first, what's listed is not affordably marked. And then a lot of it's not listed, which we'll talk about. But kind of a exciting week last week on just sort of builder sentiment, etc. Again, just ignore the noise. It's not important. Stop here. And I will try my best to give you a rounded view of what's actually happening in the housing and mortgage markets. And there is a lot happening. Okay, so welcome back again. The next thing I want to talk about is the Substack that I wrote this week. And we'll start with kind of what's going on in California with Tropical Storm Hillary, which is descending out there. This is happening when already there's been a record year for insurance losses due to violent storms and things like that. And I wrote about, we're actually in the middle of a very historic weather pattern. I am not an expert on it, but I encourage you to check out Sean Hackett. I'll link to him in the Substack. He just is, he's been on the money for the last 2 years, just in terms of what we would see in terms of weather. It's not about climate change, it's about historical weather patterns. So encourage everybody to check that out, because he really has some great insight on what are probably going to be some food shortages in 24 that you can get prepared for now. So I start the Substack out that way. And then I kind of transition. I'm here in Florida. As I said, we're kind of looking at some storms right now out there in the tropics. I'm nervous, not for my safety, but nervous about what we might see in Florida this year after Ian last year. I'm really hoping that Florida escapes without a storm. But it does not matter to the people of Florida right this moment. I mean, it will matter, don't get me wrong. But they're already concerned because insurance rates have gone up so much. And I talk about a local community here in the Miami area called Century Village, which is a very modest kind of apartment, home, condo complex, largely 2 bedrooms, people on a fixed income, retirees. Well, there was a big story that when they got their notices that their HOA fees were going up due to skyrocketing insurance costs, that there was a near riot at this location. Dozens of police officers had to respond. There was even accusations that one of the security guards kind of threw a man out. Again, this is eyewitness testimony. I'm not sure what happened. But guys, these are people on a fixed income. They simply cannot afford these insurance increases. And on top of that, if they, the taxes, and that is something, Trish Florida Sun did a great thread on the trim notices and the taxes in Florida. Definitely check that out. But taxes are skyrocketing. And so everyone moved down here thinking this was more affordable in Florida, and it's turning out to be the exact opposite. Highest insurance rates in the country for homeowners, second highest for car insurance, and I think there's some debate about whether they're the highest. So it's getting a little bit hot down here in Florida in terms of affordability, and there's a lot of anger building. So I drove by that facility. I wasn't able to get in, but I took a picture and I put it in the Substack. Again, this was very much a middle-class neighborhood. So what I did from there is I drove to the nearest new build site, which happened to be Lennar and Sunset Pines, just looking at some homes there that are listed for the high 600, or not, well, low 600s. Whereas the homes over these apartment homes in Century Village, more like in the majority of them were in the 250 range, but they kind of range from 180, and then there was just one at 450,000. I cite the exact square footage amounts in my Substack, but my point is, when these people were being interviewed at Century Village, what their response is, I can't afford to live here. The response was I'm either putting my home, listing it for sale, or I have already listed it for sale. So my big question is, who, in just a couple miles away, who will be moving to these new build spec homes that Lennar has put on there for upwards of $600,000? And guys, encourage you to look at the Substack, because they're not pretty, they're not cute at all. And 0 lot lines right next to your neighbor. Do they look a little nicer? They look a little nicer than Century Village, but Century Village has a ton of amenities. So I don't know that they are actually nicer. And then we also have heard a lot about builder quality, just quality of these spec homes. So, a lot going on there. And this little community was kind of next to a Publix, but still, I can tell from what's around and the other homes, the existing homes, this is not a neighborhood where people are going to be buying at $600,000. Okay, so and then the most important thing I want to say is that this is a prime example of why the listing sites and why the Fed does not have the correct inventory numbers. I think I've told you before that the Fed uses Realtor.com, so that's what I primarily use. But, I also look at the other listing sites just to see the difference, and there's a ton of difference. And so, but with Realtor.com, there were only a few of these homes listed for sale in Century Village existing. But if you went to Century Village's website, there was 130, handful listed for rent, but most listed for sale. Okay, so that's existing homes. So then you go to Sunset Pines, you look at Realtor, Zillow, Redfin, and I'm looking for all of these homes, which many of them looked completed, some of them not, but they're not listed on the listing sites. If you see anything, it's for one home. And again, this is an entire subdivision. So I kind of want everyone to see how this could be happening, that we're missing this inventory. Now, another thing about these listings in Sunset Pines, it says that they'd be available in 2024. Well, they look almost done. But in conversations I've had with people in the building community, as well as Trish Florida Sun, what I've kind of come to understand is that, until you do your certificate of occupancy, that's kind of like your final step, you only have to pay taxes as if this was land versus the full assessed home value. So it could really behoove people not to finish these before January and get that certificate of occupancy. Now, a big question is, how do they treat those on their balance sheet? Are these held for investment homes? Likely not. I don't know. This is something that I want to spend some time digging into, but I've been too busy driving around. So there are folks that are looking into some of this as well with me. But hopefully, I hope to do a deep dive on some of the builders in the near future. So, here we are. We've seen an example. So these are two sites. I think you guys know I've been to hundreds of sites across the country, but these are two sites that give us right away, will include Century Village. We have a case study in the fact that all the existing homes are not being listed on the listing sites. And then we see the new homes that essentially, if they're listed at all, it's one home and not the entire subdivision. So this is how we can get how people continue to think that we have an inventory shortage. Now, I 100% agree we have an affordable inventory shortage. Don't get me wrong, because what's being built out there was being built for, higher income folks and not, for affordability. The multifamily is the same, luxury. These spec homes, I would argue they are not luxury, but they were built kind of aspirationally, if that makes sense. So from there, I went to a whole new other new build site. I believe this was probably a built to rent site. Was in a very kind of blue collar working neighborhood. I talked to someone there. They said their rent was subsidized, but it was about $1,300 a month. But you can see that some developers some investors have bought in there and are trying to list existing for kind of some astronomical rent. But in reality, this is a neighborhood that has a lot of Section 8 subsidized housing. And so Lennar has built a brand new community over there, very large, looks like built to rent, because I can't find these listed anywhere. And so I found the one kind of listing I saw was on Realtor.com, very generic, for rent for $3,100. So I think this is probably an entire subdivision of built to rent. I included my sad little video of one section of driving around. Guys, so it's hard when you get on these sites. Number one, the workers are all looking at you like you're crazy. There's often security. So I do my best to get pictures and things like that. And honestly, I, I feel like I just need to redo all of these trips with someone who can capture this footage, because I would have hours and hours and hours of footage of new build sites, empty homes, almost completed, if not completed. And you can see these built to rent are completed. Maybe they haven't filed that certificate of occupancy. It's very difficult to see project statistics in the builder's financial filings. And so it's hard to really translate from what you see in front of your eyes to what's happening in their financial statements. But if they're not filing those certificate of occupancies, it's highly unlikely that these are showing up as completed with the builders. And I think, it behooves them to kind of slow roll this inventory, especially with what we're seeing with the 10-year, which is what, housing, mortgage, everybody looks at that 10-year, not just because it's usually correlated with mortgage rates, which, that correlation has broken down a bit, but still the direction is there. But it's about borrowing cost. And so when we see the 10-year at this level, which we have not seen since 2007, the models start screaming within these organizations, within the builders, within the banks, but also in mortgage. And I can tell you very much for a fact that what we went through in 2006 and early 2007, at my company, what I heard from my builder group over and over is that the builders will be fine. They will be fine. They will be fine. And people said this, we have great relationships with them. We know their financials are strong. Everything's going to be fine. Guess what? They weren't fine. And they weren't fine after the 10-year being up at this level. So we are going to see that fallout. Just like we kind of saw in December, you could see kind of at the beginning of the year was looking really scary. And then you had some well-placed media articles that started pushing these new builds. And that is really how we had that spring. So this subdivision, very large, wasn't able to count, but it was very big. Also, there was a private builder over off in another section of it. So it was Lennar plus a private builder. None of these homes are occupied that I could see. And this is inventory that nobody has anywhere. So one day, two sites, and this is what I've found, but it's just representative of everything that I have seen before. And so I'm not stopping. I'll be going to more sites in Miami, as I'll be here for the foreseeable future. Not exactly sure when I'll be heading back up to Tennessee. Okay, so that was just a really great case study. You may not read my Substack every week. This week, I really encourage you to read it because there's some good pictures, the video, you'll get a sense. Okay, so the next thing I want to talk about is the case study around funding and short-term rental, and in this term I'm coming up with Airbnb broke. So guys, let me give you the scenario. I heard about my buddy who has a short-term rental down in Austin, and he is making bank. He probably bought it around, 2013, maybe 2019 even. Okay, so you decide to Google and how can I find one of these properties to buy for short-term rental? Where's the best place for short-term rental? So you do some Googling. You find a broker or somebody who, or you find one of these influencers that tell you how to do this. From there, you essentially are going to go look for a service like AirDNA, MASH Advisor, to tell you what your financial projections are. and you're going to type that address into one of those, and up is going to pop some projections of what you could get for your average daily rate, theoretically based on comparables very close to you, at what your monthly revenue would be, etc. Guys, what I'm here to tell you is that the models behind these services are, I honestly don't exactly have any idea how they're pulling comparables. So in my Substack, I give an example in Kyle, Texas, of a loan I've seen in a portfolio that's delinquent. It's a second home. You can tell it was bought for investment. It was in one of these spec communities. He paid $585,000 for it. The median income in this town of 58,000 people is $80,000. They can't afford a $585,000 home. So more than likely, I mean, he bought it for long-term rental, probably, maybe short-term rental. What these tools say that he would make on this property were over $600 an average daily rate. There is nothing around, guys. So this is how these things mislead you. And guess what? A lot of institutions who are lending money rely on those models and use them as they are doing their underwriting. Because I've talked about the DSCR loans, debt service coverage ratio. Those loans essentially are the stated income Alt A that we had in the last crisis, but they're also doing interest only. And, I know responsible lenders who believe that they were getting good information from these providers, and they used it to help with their underwriting because these providers are not taking into consideration the macro. They're not taking into consideration things like median salary, etc. And they're just listing on these projections for either short-term rental or long-term rental based on what happened over the last 3 years. And guys, we know that this is a very atypical market, so you can't do that. But I'm hoping to give you guys a picture how even well-meaning people can find themselves upside down in this situation because they're relying on what other people are saying. But just like you can't trust our mainstream media, you can't trust any marketing either. You have to ask questions. Nothing comes for free in this life, and you have to stop and do your due diligence. If you don't, you will be paying the price. And this borrower in particular had a $17,000 tax payment come due that he didn't pay. That escrow was forced, and now he's desperately trying to sell this home. It is unlikely he will get there. I don't see him getting anywhere near $585,000 unless he can find another sucker. Okay, so just want to talk quickly about commercial real estate. A lot going on there. In the Substack, and include a chart of what people think in terms of estimated losses. I think a lot of people want to make this about work from home. This isn't about work from home. It is a component, but this is about how we built and built and built and built and built, like everyone on the planet would be living in these cities, working in these offices, in this hyper financialized world. So we overbuilt before COVID, guys. This was a problem before COVID. And so it's just the problem's coming home to roost. And we have not done any thoughtful analysis about how much office space, how much retail space, how much industrial space we really do need, with the backdrop of our aging and decreasing demographics. So these folks that think commercial real estate, they talk about it as a problem, but they think it's a problem that's manageable, or that we understand the scale of the problem. We do not yet. So please, as much as everyone seems to be talking about it, I feel like they're talking about it because nobody's really talking about it, if that makes sense. Okay, so there was a lot going on. That was a long intro. I wanted to give some of those updates, and I haven't been able to spend as much time with you guys in the last month. So apologies for that long intro. We're lots of data now that I have all this short-term rental data. But we'll kind of race through things today. Inventory was pretty flat. In the cities I track, it was down 0.45%, but there were some big movers in there that really, I don't do weighted averages for these, although I probably will do that in the future. But just very quickly, race through these. Top cities with largest percent increase in inventory week over week, 8.6 to 8.13. So Rosemary Beach up there at 11%. Westchester County, something's going on there in Westchester. If anybody has any idea, let me know. At 7%, Augusta at 6.24%, Portsmouth at 5.71%, and Rochester at 4.71%. Top cities with largest percent increase in inventory compared to 8-week average. San Ramon, again, 19.6%. Nashville, sticking up here against the average at 12%, up from number 4 last week. Encinitas, 11.53%. And guys, I'm so glad I'm tracking all of these California cities. It's going to be very interesting to see what happens after Hillary. Rosemary Beach up at 9.95%, and Costa Mesa up 6.31% against the average. Okay, and guys, I in the Substack this week, I do the full schedule update. So if you want that schedule, let me know. You can try accessing the Google Doc. I'll give you permission, or you can leave me a comment here. Okay, and so our top 10, I'm not going to go all the way through them, but I will say that we had Bozeman come in, knocking Nashville out of number 10. And so that was really the biggest movements, but San Francisco did move up again. I kind of asked the question, has San Francisco bottomed? Definitely kind of that the listings coming on like a swarm has slowed, but in the top 10, biggest move, Bozeman kicking out Nashville for now. Okay, then top cities with highest percent increase of single family rental listings, same week. Rosemary Beach up 100%. Now these are, small numbers, but it was a true doubling of inventory there. Portsmouth, and again, this is single family rentals. Portsmouth up 50%, Galveston up 15.89%, Carlsbad at 12.57%, and Encinitas at 11.58%. Going to be very interesting to see what happens after Hillary here. And then top cities with the highest percent increase of single family rental listings to average. Rosemary Beach, 24%, Encinitas, 20%, Portsmouth, 20%, Coeur d'Alene, 19.5%, and Augusta at 16%. And then I always like to have the highest percent decrease in single family rental listings. So down 17% for Brattleboro. I can't say that very well. 16.7% for Sevierville. Down 6% for Costa Mesa. And so that move, perhaps moving from rental to listing for sale. And then Oceanside down 5% and Boston down 5%. Okay, so Airbnb, VRBO, short-term rental. Okay, top cities with the highest percent decrease in average rate compared to 12-week average. Rosemary Beach down almost 49%. Hoboken down 29%. Indianapolis down 28%. Destin down 28%, Sedona down 19.5%. Top cities with highest average daily rate for July. So I didn't have these numbers last week, so I included them this time. Newport Beach at $771.53 for an average daily rate. Westchester at $744.91. Rosemary Beach at $720.82, Cape May at $592, Encinitas at $576, $576. Okay, and then I did go ahead and put in the Substack. I'm not going to read it off here, but just the same highest average daily rates for July 2022. Interesting, those moves, some higher, some lower, but all the same cities. And then lowest occupancy for July 2023. So Augusta at 55% occupancy, Winter Garden at 51% occupancy, Palm Springs at 52% occupancy, Phoenix at 55% occupancy, and Sedona at 55% occupancy. So, that's pretty low occupancy for what people had hoped to make in these areas. People really wanted 60 to 70% at least occupancy. Okay, again, for commercial real estate, I put a chart in that said, estimating CRE value losses versus recent peak, and on average, it shows coming down about 18%. I think every sector's in trouble. I think multifamily is in way more trouble than anybody understands. Office is in way more trouble, and industrial is not immune. I have seen so many empty industrial sites on my travels. So, what I would say is if you are confused, if you think that I'm a crazy lady, like a lot of people, just take a drive or have your cousin take a drive and they're in one of these cities. Just, talk to me, reach out to me, leave a comment, and I will give you an address. Now, it's not every single city across the U.S. However, it is in most. There is a pocket of it in most cities. And these spec homes are an infestation. They are a swarm. I would say that even way worse even in Austin, Phoenix, and Las Vegas than, here in some places in Florida. Now, in others, like where I am in Miami, I've only seen a couple of sites. We'll see what else I see. Definitely other places in Florida where there is this infestation. So thanks for joining. As always, you can reach me on Twitter at M3_Melody, on LinkedIn at Melody Wright, on Substack at M3 Melody Substack, and here on YouTube. Thank you again, guys. If there's anywhere you want me to see here in Florida, please leave a comment. I will be here, as I said, for a few more weeks at least. So happy to tool around and see what I can see. And next weekend, I will be spending more time here in Miami. So thanks again for watching and have a wonderful day, everybody. Thank you.